For weeks, I've been talking about rising interest rates and the possible impact on the housing market. But suddenly, mortgage rates aren't rising anymore. Perhaps until the Fed finally actually starts selling some of their mortgage holdings. Mortgage rates have been having trouble staying over 4%. And meanwhile, homebuyers are not stopping. There are no signs of slowdown anywhere in the data yet. Speaking of rising rates, this week I interviewed Bloomberg columnist and money manager Connor Sen on the Top of Mind podcast. Connor is one of my favorite social and economic trend spotters. He shared his logic for why it's hard to imagine rates climbing over 4.5% this year. And if that's the case, why there's very little impact on housing demand. If you haven't yet subscribed to the Altos Top of Mind podcast, it's where I interview the thinkers and leaders in real estate to put context beyond the data. Connor's interview is a great example. I don't personally have any ability to predict mortgage rates. So I look to sophisticated, skilled economic forecasters to help us understand. Connor and I talk about much more than just mortgage rates. Things like the supply chain and how that crisis may actually be the bigger driver of the real estate story for the year. Anyway, Top of Mind is the name of the podcast. You find it where you find your podcasts. It's also on the Altos YouTube channel. Each week, Altos tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, and the changes in that data, and we make it available to you before you see it in the traditional channels. You know, traditional real estate data is monthly, and so it's kind of old news by the time it gets to you. So join us with Altos Research. I'm Mike Simonsen. I'm the CEO of Altos, and let's look at the data and the details for the week of February 28th, 2022. Let's start with available inventory this week. New week, new record low in homes for sale, available homes for sale. Just 244,000 single family homes on the market right now, with another 80,000 or so listed this week. There are no signs yet of increasing inventory for the spring. Normal years, inventory would be climbing by now. Last year, the nadir of our available inventory wasn't until April 30th, though. And it looks like we're aiming for a repeat of last year right now. As we approach the 2-year anniversary of the onset of the pandemic, I've labeled each of the charts in this week's video with their pre-pandemic readings. So you can see that just before the initial pandemic period, we were already at a record low, then record, of available inventory of 724,000 homes on the market. But the market had already started to climb like normal years. So we had just 4 weeks of inventory climb in 2020 before all the rules changed. The question right now is what's going to happen with rising rates this year. So this is our model of how rates may impact inventory. Each line here is the inventory curve for the year. 2018 is the dark blue line here, and that's when interest rates were rising. So inventory climbed just a bit in 2018 as rates rose. The dotted line at the bottom is where this year will look if it follows a similar curve as 2018. This year's already different, though, from 2018 because inventory is still falling 1.5% per week. In 2018, we were already past the low point and inventory was starting to climb already. So maybe our inventory climb gets shifted to the back half of the year and we can end the year with 360,000 or so single family homes off the record lows. Fingers crossed. By the way, we have our monthly webinar next week is March 10th at 10 a.m. Pacific, Thursday. In our monthly webinars, we take an hour to dive into all the data, spend more time with the forecasts. We look at local markets too. If you need to figure out how to communicate what's happening in this crazy market this year, you should join us for that. There's a link to register for the webinar in the description below. Click that. All right, let's shift to prices. The median home price is surging quickly now, as you'd expect for spring. The median price of a single-family home in the U.S. this week is up 2% to $389,900. That's almost 12% higher than last year at this time. A few things I like to point out with this chart. You can see the pre-pandemic point was 319. That initial pandemic reaction had exactly 4 weeks of price declines before prices surpassed their previous high. 4 weeks. So you can see that tiny little dip there. I've also labeled on this chart that 2018, 2019 period of rising rates. I showed you before where rising rates caused inventory decline, but notice here that there were no price declines in that same period. Home prices were still several percent higher than the previous year, even though rates rose through all of 2018. So that's the likely scenario for this year. Expect increased inventory, but not some sudden bargain prices. 2018 sure seems like a good guide here, and the results of those rising rates seem pretty clear. The price of the newly listed cohort, that's the light red line here, is still shooting higher too. It's at $398,000. The new listings are coming on the market priced well above the existing stock. Recall that the way these prices work into the system is that a house gets listed today, it gets an offer in March, it closes in April. So the new listings is a powerful leading indicator of future transaction prices. So any given home may be over or underpriced, but in aggregate, the sellers and the listing agents know exactly where to price to sell the house. When the new listings price jumps like this is because there's a ton of buyers and they're bidding up everything that becomes available. What's going to be fun to look for is the $400,000 price point. It's a psychological resistance for buyers and sellers. Last year we got to $399 and then plateaued. So this year it's going to be fun to watch when prices break through that psychological barrier. You can see historical barriers in previous years where the prices plateau for the whole summer. So if you could price it $401 or $399, you tend to go under that threshold to maximize your bidders. So we'll see when we break through that $400,000 psychological barrier or if we hit a ceiling for a little while. The immediate sales is our favorite tracker right now of that intense market demand. These are the homes that get listed and then take offers and go into contract essentially immediately, hours or days from listing. If the market is cooling due to higher mortgage rates or other factors, we will see fewer immediate sales. However, as of this week, immediate sales are growing in total number and as a percentage of the new listings. 75,000 new listings this week and 25,000 of them went into contract immediately. So finally this week, let's look at time to sell. The median market time always plummets this time of year. The best new inventory is getting listed and goes quickly. This year's already screaming fast and faster than last year. Last year there was still some junk on the market, which skewed the median time higher. Now all of that stuff is sold. The best time to sell a crappy home is into a hot market. So we're already down to just 35 days right now. Last year it was 55 by the end of February. Pre-pandemic, much more normal to see like 85 days, 3 months on the market as a median time. In those times, some go quickly. There were some immediate sales, fewer than there are now, but some immediate sales. And some overpriced or hard to sell homes linger on the market, which meant the market time skews higher. All those signals are gone now. One way to this days on market is one way to show how hot our market is across all price points and all geographies in the country. We have a few more months of the hottest spring market before things start to calm down in the second half of the year. Like the immediate sales or our price reductions measure, DOM is a very straightforward way to see how rising rates cool demand. There is no cooling anywhere in the data yet. Okay, that's all the time we have for today. As I mentioned, the link to register for the Altos Research March webinar is in the description below. That webinar is next Thursday, March 10th at 10 a.m. Pacific. Click that, join us. We get a ton of participants, and these lots of interaction, really great time. So you should join us too. To get your own local Altos data for your markets, branded for you so you can reach your clients, just go to altosresearch.com and book time for a free consultation on your local market. There is a link for that in the description below too. Click it, join us. See you next week.